My name is James Hayward and I'm from Homes England's Local Government Capacity Centre. I'm delighted to welcome you to our Winter Learning programme. This offers a series of knowledge sharing sessions on topics you've told us are of interest to you. Today's event is a guide to viability and development appraisals. This Winter Learning programme is brought to you by Homes England's Local Government Capacity Centre, which launched in the summer of last year. So this slide summarises who we are and what we do. We've launched the centre following extensive research and consultation with you across local government and with a whole range of other partners to determine where authorities need the most support and how this can best be delivered. So just a quick word from our CEO. I'm delighted to open this session for Homes England's Local Government Capacity Centre by showing you his message, Peter Denton's message. As you can see, Peter is committed to ensuring Homes England supports your work and shares expertise, experience and skills to get homes built. So now I think I'll hand over to Andrew to kick off the session with the agenda. Thanks, Andrew.
Okay, thank you, James. Just obviously going on to the main page here. So Development Appraisal and Viability. Thank you very much for attending, everybody. Good afternoon to you all. It's great to see so many people attending. We can see those as they are registering, so it's great that you're here. So look at the presentation and interactive session. So yeah, quite simply, today's session will look at relatively high level at development appraisal and viability. As mentioned by James, I understand that a copy of this PowerPoint will be made available afterwards. So if there are certain elements you want to catch up on, you'll be able to do that as it comes through a few days later. If I can have the next slide, please. Just very quickly by way of introductions. So my name is Andrew Moss. I work as a principal within the Birmingham Land and Development team. I've worked with Avison Young for about 24 years. I'm joined today by Rachel Hill, who is an associate director within the same team as me. Rachel and I have worked together for about 15 years, and we both actually started as graduates at Avison Young. And then finally, Dale Robinson, who is a director within our Leeds Planning, Development and Regeneration team. Dale has worked with Avison Young for about 20 years. It's worth mentioning, as seen on the slide there, we are all RICS registered valuers and RICS qualified surveyors. We focus primarily within the residential and mixed-use development sectors. And as a reflection of that, it's probably fair to say that we deal with development appraisal and viability on a regular basis, if not a daily basis. So if we can jump to the next slide, please. So just in terms of the agenda for today, myself and Rachel will be taking you through part one of what is a two-part session. Within part one, we will take a high-level look at what we mean by viability and how it can be assessed in terms of development appraisal techniques. I will also be looking at professional and policy guidance with a particular focus on planning and the RICS, the planning framework and RICS. I will then have a quick look at common applications of development appraisals within the property industry, just giving you some real world examples as well, just to put that into some context. And then finally, I'll have a quick look at some top tips for users in the context of viability development appraisal. I'll then hand over to Rachel, who will take a quick look at the commonly used development appraisal models within the industry. And she'll also provide an overview of the main development appraisal assumptions. And then part two of the session will be covered by Dale. Dale will be delving a lot more into the detail of development appraisals through what we hope will be a very interesting, interactive, well, I know will be a very interesting interactive session. As mentioned, there'll be a couple of polls, so obviously very much appreciate your participation in that. And at the end, hopefully we'll have enough time left over for a questions and answers session. So if we can move on, please, to the next slide, and then the next one again, please. So going into part one, what do we mean by viability? So the National Planning Policy Guidance, NPG, which some of you are familiar with, but which we'll touch on later, sets out the government's recommended approach to viability assessment. in the context of planning. In this respect, the government.uk webpage defines viability as what we can see in the screen there. So a process of assessing whether a site is financially viable by looking at whether the value generated by the development is more than the cost of developing it. So I think quite a straightforward assessment there. Can you please pop on to the next slide? Okay, so next slide, how is viability assessed? So it's basically assessed by adopting development appraisal techniques. In this respect, development appraisal is very much an integral part of the development industry and the property industry, being relevant in, I think, probably pretty much all development market sectors. It's a technique which is used to assess the financial viability of development, having regard to multiple inputs and outputs, which we'll explore in greater detail as we go through this session. It's commonly used with other techniques, so not necessarily a standalone technique, such as the comparable method of valuation, and is also very often reliant on significant wider inputs, such as physical and technical site due diligence, sales evidence, master planning, etc. As mentioned, in my particular specialism, I work within the residential development sector, where development appraisal is the main technique used to assess residual land value and viability. So as per the slide, the appraisal represents an analysis of the development intended, where the land value is a residual element derived from several variables under the main headings of gross development value, GDV, total development costs, TDC, including the profit to the developer for taking the development risk and delivering the scheme profit. It can also be used to determine profit, where the land value is included as a cost. So if we can jump onto the next slide, please, which just really looks at a very high level, a basic residual appraisal. The slide here shows the different elements. You can see how under gross development value, it's, as the title suggests, really, it's a combination of those revenue elements of the development. So you're looking at private sales values, affordable housing, commercial values, etc. We used to, for example, take into account residential ground rents, but due to changes in legislation, that isn't the case anymore. So the gross development value, the value of the completed scheme or the assumed value, from that, we then take off development costs and profit. Development costs, you'll see there, including building costs, design fees, planning obligations, etc. Again, we'll go into that in some detail later on. And then developers' profit, which can also be used as an output within the appraisal. So GDV less total development costs effectively leaves the residual land value, so the difference between the gross development value and the development cost. Deductions are then made. It's important to remember this for stamp duty and purchase costs to derive the net residual land value. So in viability terms, the residual land value can be measured against the existing use value of a site or a property, or a benchmark land value, which is the level at which the landowner may expect to achieve in a disposal, may expect to achieve the land value. In relation to residual land value of the scheme, if it's lower than the viability of the proposed development, sorry, let me just start again. If the residual land value of the scheme is lower than either the existing use value and or the benchmark land value, then the viability of the proposed development is challenged in that example. However, viability can be assessed in other ways. So as we talked about, if land value is a fixed input, then profit can be used as a required output. So in this instance, profit can be used to measure viability by assessing the level of return supported by a development appraisal against a particular benchmark level of return. So just putting that into an example, if a developer had a hurdle rate for a development return of 20% profit measured against gross development value, and the residual appraisal that was run only supported 15% gross development value, then in this instance, the appraisal demonstrates that the viability of the scheme is challenged, again, relative to the hurdle rate that developer is looking for. But we will explore this a bit later on in Dale's interactive session. If we can go to the next slide, please. So there's quite a bit on this slide, and we don't really have the ability to go into the various guidance and publications in a lot of detail, but I will give some references to where they can be found. So just really wanting to touch on policy and professional guidance, which is out there. The first one of those, a lot of you should hopefully be familiar with the National Planning Policy Framework, the NPPF, and the Planning Practice Guidance, PPG, which was the documents published to support the NPPF. These were first published in March 2012, or at least the NPPF was, followed by the guidance. It was revised subsequently in 2018 and 2019. And most recently updated, although it was published in March 21, it was actually effective from March 2021. For those who may not know the size of it, the latest version of the NPPF is a 75-page document. It does specifically refer to viability assessment within paragraph 58, and there's also reference to earlier guidance. It also makes reference to certain benchmark variables which should be considered when undertaking development appraisals, such as what's perceived to be an acceptable level of developer return, stroke profit that should be adopted. Dropping down to the next one. So in response to the NPPF, in 2012, the RICS published a guidance note, Financial Viability in Planning. There was then a bit of a gap, but it was followed thereafter by the RICS Professional Statement, Financial Viability in Planning, Conduct and Reporting, first edition, May 2019. And again, obviously, the publication of that follows the update to the NPPF. There was then subsequent guidance issued. It was a guidance note issued by the RICS, a bit of a mouthful, this one, Assessing Viability in Planning under the NPPF 2019 for England. That was the first edition. Again, it was issued slightly earlier in March 21, but it actually came into effect in July 2021. And it's very much aligned to, obviously, the most recent iteration of the NPPF and PPG update issued in 2019. And then this detail, all of those publications effectively issued by the RICS are there to provide guidance to RICS regulated firms and their employees, registered valuers and other practitioners involved with the provision of financial viability advice in the planning arena. And then there is another one which we mentioned here, which is the RICS guidance note, Valuation of Development Property, first edition, again in 2019. This is a good one to look at. It goes into a lot of detail in terms of development appraisal techniques, but it should be considered in tandem with the RICS Red Book. And I'll touch on what the Red Book is for those who may not know it later on. So if we can drop down, please, to the next slide. So on this one, the next three slides, I just really want to apply a bit of knowledge as to where the different publications may be applied in the industry, common applications for us in terms of development appraisal and viability techniques. So the first one of these, formal valuations, RICS registered values, so undertaken by people like myself, Rachel, Dale, and quite a few other colleagues within our business, and obviously wholesale across the industry. For me, as a RICS registered valuer, development appraisal is very much a go-to and a recognised valuation technique when assessing viability and land value. And when used properly, it is an extremely useful and valuable tool. It's regularly used for, as this slide suggests, the provision of formal valuation advice, very much in keeping with the RICS Global Valuation Standards, which is otherwise known as the Red Book, as previously referred to. Up until today, the most recent edition of the Red Book was issued back in 31st of January 2020, but today a new publication of the Red Book does actually become live. So for those of you who may need to refer to that, make sure that you're referring now to the update version. And for those who may not know, the Red Book it's a very extensive publication. It has to be purchased by all those parties registered with the RICS, so it's not commonly available on the internet, and it's often referred to as the Bible by registered valuers when providing formal independent valuation advice on land and property within the UK, but also abroad. So it is recognised and adopted in a lot of other countries. And in this context, it's commonly used for formal loan security purposes. That's in terms of residual development appraisals, often supported by other techniques, such as the comparable method and direct market evidence. As discussed, you generally, where you can, you don't use development appraisal in isolation, and you will always refer to market evidence where it's available. So just to put that application, formal valuations, in the context, as a department, we, for about 10 years now, have undertaken annual valuation work for a principal high street lender. They are the main funder to a local regional house builder, and we do all of the loan security valuation work related to land purchases by that house builder. We probably do about 10 valuations a year for them. So as said, it's a contract which has been live for over 10 years. So just for that one client alone, it's obviously a lot of valuation work. If we can jump onto the next slide, please, Dale. So this is just a further continuation of applications. Another one that's commonly used, financial viability, so development appraisal is commonly used for financial viability assessments in the planning arena, as mentioned above and as referenced within the NPPF and PPG. It's probably most commonly seen in Section 106 agreement, sometimes referred to as planning gain viability negotiations, as well as area-wide assessments, such as those related to setting SIL levels, community infrastructure levels, and setting affordable housing provision. So again, just giving some recent examples of where they've been appraisals have been used in those arenas. I've recently been involved in a couple of Section 106 negotiations, one for a 100-unit city living scheme on the edge of the Jewellery Quarter here in Birmingham, and also not a million miles away, been involved in 106 negotiations for an edge of settlement 2,000-unit sustainable urban extension. In both of these cases, we were acting for the promoters stroke landowners. In both instances, using development appraisal techniques, we were able to demonstrate that viability was challenged, largely as a result of abnormal development costs. And this resulted in the local authority agreeing to a reduction in the percentage of affordable housing from the stated policy compliant position. You will also often find that if we're acting for a landowner, we will submit an appraisal, assuming it's accepted, a viability appraisal accepted by the local planning authority, because they don't have to accept them as part of an application. And the authorities will therefore often independently appoint their own advisors who will do what we do, but in an assessment capacity. So quite often we are drawn into negotiations on behalf of our client with advisors acting on behalf of the local planning authorities. We have provided, we've acted for a couple of local authorities, including Birmingham City Council, in all the background work and justification for establishing their SIL charging levels, falling within their areas of operation. And also historically, I, for example, did a lot of work in supporting a local authority in revisiting its affordable housing policy, which ended up me attending a local planning inquiry on behalf of the LA, just supporting the level of affordable vision that was being suggested, demonstrated through appraisal techniques and viability testing. And then the next slide, which is the last one in terms of common applications that we're going to touch on. So there's 4 different ones on here. Just very quickly, market assessments. So with my agent's hat on, we're often used to give indicative high-level assessments of what a potential site value may be when it's offered to the market. And we will very much use development appraisal techniques, making our own view on assumptions to give an indication as to what the potential receipt might be. In terms of options appraisal and sensitivity analysis, development appraisal is extremely useful. So again, as an example, I'm currently working on a number of large schemes for Homes England, where we are working with the client team and the wider project team, including master planners, to identify the most kind of viable and valuable market-facing scheme, taking account, of course, of other requirements that Homes England may have in bringing the scheme forward. To help establish, what is the best scheme for the market, which is then to be progressed through planning and ultimately through site disposal. Funding applications, public procurement as well. As a further example of this, we've recently assisted a number of local authorities, and obviously there are other firms who will have done the same, advising on the future High Street Fund applications. We have also been involved. So in those scenarios, we've helped to identify potential gaps in viability and opportunities to bring forward town or city centre regeneration, and through using the development appraisal techniques, we've identified where there may be gaps where grant funding has been applied for. Another live example, myself and colleagues within the team are currently undertaking some independent assessment of grant applications submitted by various developers to a combined authority where there is deemed to be a funding viability gap and where they're applying for grants, and we're independently assessing whether that is the case. And then on this slide, the last example, dispute resolution. Again, just easier to relate to examples. So I was involved a few years ago in an arbitration where I was acting for a landowner and we were unable to agree with the house builder the option price on a drawdown for a purchase of a big parcel of land. It went to arbitration and I was then appointed as expert, and as part of our evidence base, a strong part, we used development appraisal techniques, as did the party acting on the other side, again supported by comparable evidence. Another example where I've got a couple of live cases where I'm involved with land compensation claims, where we're acting for a public body. Both of these development appraisal techniques are a large part of the argument on both sides, and in this scenario, at least one of them is probably going to end up at Lands Tribunal. So as you can appreciate, the evidence we're giving and the reinforcement of that is very important. Again, reinforced by transactional and market evidence. If we can jump to the next slide, please. This is the last of my slides, and really it's just to give a few top tips. This slide should probably be better just headed as top tips and observations. So just going down those in order. Development appraisal, for those who will know already, but those who don't, they are extremely sensitive to changes in the variables that are made, and Dale will go through that in his live interactive session later. As we've touched on, they're very useful for sensitivity analysis, so you can look at a number of different options and change a number of individual variables to see what impact they may have. It's important to understand that the inputs should reflect the status of the advice you're giving. So again, in a market assessment scenario where the appraisals are high level and not formed in red book, you can take a view on some of the inputs. Clearly, if you're undertaking formal, or you're asking somebody to undertake a formal red book valuation, then the inputs have got to be fully researched and supported through the due diligence and comparable market evidence. As we've touched on, the outputs can be varied. So depending on how you're wanting to assess viability, you can have fixed outputs and inputs, whether they be land value and profit. As Rachel will touch on, the appraisals are also very good in terms of having a detailed cash flow attached to them. So they've got strong cash flow capabilities and also sensitivities associated with phasing. So on large multi-sector schemes, or multi-phase schemes, you can look at different phases through the longevity of the project over many, many years. So they are a very useful tool for doing that modelling as well. And then finally, just a reference source here, as mentioned, if you go onto the RICS website, you'll be able to download the majority of the documents that I've referred to above in terms of guidance. I said you won't be able to download the Red Book because that's paid for, but you can all subscribe if you want to. And actually, if you were to do a straightforward Google search, you will find most of the documents as well, again, subject to the Red Book not being on there. So I think that's it for my section. If we can have the next slide, please, and I'd like to hand over to Rachel. Thank you.
Okay, thanks, Andy. So today I'm going to provide an overview of some of the most commonly used development appraisal packages, the format of these, and I'll also briefly run through the main inputs that go into a development appraisal. The most widely used formats include Pro Developer or ProDev, as it's more commonly known, Argus Developer, Homes England Development Appraisal Toolkit, or DAT as it's referred to, and also various Microsoft Excel formats which can be produced bespoke. And Dale will be taking you through an example of a development appraisal in an Excel format later in the session. So we're going to focus on a couple of the development appraisals in Argus Developer and ProDev formats. And for those who aren't familiar with these packages, you will be able to see how they differ in appearance and appraisal structure. So next slide, please. Thank you. So the example that we have here is an example of an Argus Developer appraisal. This is paid subscription license software. It can be used for residential, commercial and mixed use appraisals, including investment valuations. The Argus software enables the production of single or multi-phase projects and allows any changes to be viewed instantly. It also provides debt and equity financing functions right down to the individual phase levels. So this software is better suited to multi-phase, more complex schemes due to the level of detailed inputs that's possible. The example that you can see here is a hypothetical city centre scheme, a city centre scheme of apartments with some commercial situated on the ground floor. We've annotated the appraisal here to show the various components within the appraisal. So they're numbered through 1 to 4, 1 being gross development value, or GDV as it's referred to, 2, development costs, fees and finance, 3, profit against various performance measures, and 4, acquisition costs and land value. So just jump into the box that deals with profit. You can see here from the performance measures that are calculated in this appraisal that it's producing a profit of 7.37% on GDV, and we therefore consider that this would be an example of an unviable appraisal at this level. And we'll discuss in more detail why this is later in the session. So if we can have the next slide, please. So this next slide is an example of a ProDev appraisal of a hypothetical traditional housing scheme. As you can see, it looks very similar to the Argus Developer software and can also be used for residential, commercial and mixed use appraisals, including, again, investment valuations. So this software is relatively simple to use in comparison to the Argus Developer software. It's set up in a simple list format for entering data for revenue, costs, timescales, interest and profit to provide a residual site value or another residual value against a desired profit. The software can quickly and easily allow you to carry out sensitivity testing to see how changes in the different variables such as bill costs, for example, can affect the appraisal. It also has a number of other useful settings, which gives you the ability to easily switch between metric and imperial units or values per square foot, values per unit, for instance. So this enables you to enter the data in the form that is actually available to you. So both packages allow you to easily export your final appraisal and cash flow to Excel, Word or PDF, or you can simply print out your appraisal, which looks like the example that you can see on the screen. So you can see from this example that the appraisal is broken down into the same 4 elements, GDV, development costs, profit and residual land value, albeit they are in a different order to the Argus Developer appraisal that we've just seen. So this example here shows what we'd consider a viable scheme, or looking at the profit on sale or GDV, which is illustrated at 17.3%, and you can see that in box 3. So whilst the 2 examples provided you will see as a basic appraisal export from the software. So this is what you will see when you sort of hit print or export. Both software models do actually have detailed cash flows which sit behind this appraisal summary, and they can be tailored for the specific appraisal through the timing functions. So both models also have capabilities for multi-phase schemes and to perform sensitivity analysis. So you could perhaps do some sensitivity analysis to show, say, 5 or 10% variance in costs or revenue, and to see what that does to your residual land value and your viability. Okay, so both are paid subscription software models. They can provide consistency to reduce errors in appraisals and calculations, but this is provided that the inputs that go into the appraisal are robust, because the appraisal will only be as robust as the inputs that go into this particular software. Okay, so if we can just have the next slide, please. So the next 4 slides will look at the 4 appraisal elements of GDV, development costs, profit and land value in a little bit more detail. So if we can have the next slide, please. Okay, so gross development value. In arriving at the gross development value, or GDV as it's referred to, there are a number of things to consider in arriving at what assumption for GDV should be inputted into the appraisal. The appraisal assumption should be based on evidence, which can be collated in a variety of ways, such as comparable evidence of recent sales or lettings. In example of a traditional housing scheme or apartment scheme, you would ideally look for comparable evidence from earlier phases of the scheme, if that's available, followed by evidence from similar comparable schemes in the vicinity. So in collating this evidence, new build evidence should be prioritised over evidence of those sales which are second-hand or resale properties. And it's also useful to consider at this stage the evidence that is being considered, or whether that is achieved prices or asking prices, as you usually see that there's a variety of incentives and discounts that are offered on new build properties. So this needs to be taken into account as well. It's also useful to consider evidence of demand by way of rates of sales of either earlier phases or comparable developments. So as an assumption on sales rates will be required when deciding on what cash flow timings for input for these sales that are taking place are appropriate. From an affordable perspective, it can be useful to consider agreed prices or offers from registered providers when considering what might be an appropriate level of GDV to be attributed to the affordable elements of the scheme. You'd also look at considering an affordable grant, and here you should refer to any Section 106 agreements to consider whether affordable housing is to be delivered via a Section 106 agreement or not. And finally, from a commercial perspective, evidence of rents and yields can be obtained. These can be obtained through speaking with local agents or through services such as CoStar and EGI, which provide databases of commercial transactional evidence. Okay, if we can go on to the next slide, please. Okay, so we're just going to have a quick poll question now, which should shortly pop up on your screen. And this relates to our next appraisal element of development costs. So the question is, what sources can be utilised for the assessment of base build costs? And you'll see a couple of options that have popped up there. So BCIS, Building Cost Information Services, independent cost appraisal, tendered prices, some of the above, or all of the above. So if you would like to select what you think could be the correct answer there. Okay, and I can see that the answers are coming. So let's just give it one more moment for the final poll responses. Okay, and it looks like most of you are on the right track with the answer. I've got 76% showing up at the moment. And that answer is all of the above. Okay, so all of these sources can be used for the assessment of base build costs, whether individually or using a combination of these sources, and this will entirely depend on what information is available to you and the purpose of the development appraisal. Okay, so let's have a look at development costs in a little bit more detail. If we can have the next slide, please. Okay, so development costs. Development costs are made up of a number of costs, fees and finance, which are all expenditure on development. These include site acquisition costs, such as stamp duty, land tax, and legal fees, which are incurred on the site acquisition. Prelim costs, which can typically be around £5,000 per week, but are site-specific. Prelim costs would include site-specific overheads that are related to the running of the project and not accounted for under labour or materials. Okay, site preparation costs, which again are mostly site-specific. External works, these can typically be between 15 to 20% of the base build cost. Infrastructure, this is a site-specific cost relating to the specific development layout. And abnormal development costs. Now, these are especially site-specific, but could include a whole host of costs, including, for instance, remediation, enhanced foundations because of abnormal ground conditions, ecological measures, or other costs which are required to facilitate the development. So these are very site-specific costs. Sales and marketing and legal fees, these are based on the units to be constructed and are usually expressed as a percentage or a per unit cost within the appraisal. And just moving over to the second column, base build costs. So we've touched on BCIS, and BCIS is often utilised. These costs can be adjusted for geographical location of development and are kept up to date by the Building Cost Information Service. So the BCIS costs that can be obtained do include prelims. So you should ensure that where you are using this source, there's no double counting. Whilst the BCIS cost does include prelims, they exclude, sorry, to be clear, other items such as external works and infrastructure, etc. So these should be added in separately to the development appraisal. There may also be enhanced design costs required through LPA policy, such as requirements for specific materials to be used, for instance. So these will also be an additional cost into the development appraisal. And they can also come under the heading of abnormal development costs. So it's always just best to double check that there's no double count in there. And if there's a Section 106 agreement in place and it's available to review, there may be other costs associated which should also be included. This also applies to CIL, Community Infrastructure Levy. So if the site falls within a local authority which has adopted CIL, these costs should be included as well. Project or professional fees, as they're referred to, these are typically between 5 and 10% of build costs. And moving on to finance, now this would usually be applied within the appraisal as 100% applied to 100% debt, and these are normally between 5.5% and 6.5%, but again, these can vary. Depending on the particular site, for instance, if the site is a large-scale site, inflation may be appropriate to be worked into the appraisal as a cost, but it's generally excluded from development appraisal. Okay, if we can just move on to the next slide, please. Okay, so we've got another poll here for you. Again, you'll see a pop-up with a multiple choice question. The question being, at what percentage profit against GDV, gross development value, would be appropriate for a new build mixed tenure resi scheme? So you've got a couple of options there to consider. If you need a hint on this one, you might recall our example of the ProDev appraisal, which showed a viable scheme. And if you can recall what percentage of profit that appraisal illustrated, then that should give you a really good steer on what the correct answer is in this case. Okay, so let's give it a little bit longer. I can see the responses are coming in. Okay, great. So again, looks like everybody's on the right track. So the correct answer here is between 15 and 20%. So let's go on to find out why. If we can have the next slide, please. Okay, so just looking at profit. So PPG, which Andy has touched on earlier, states that the assumption of 15 to 20% of GDV may be considered a suitable return. The guidance also states that a lower figure may be more appropriate for the delivery of an affordable housing scheme, where there is a guaranteed end sale at a known value, which creates a lower level of risk. So in this case, the profit would typically be around 6% of GDV. So while PPG is aimed towards viability in plan making, many practitioners do refer to the guidance for viability in decision making. So the level of profit needs to have regard to the particular project and take into account the scale of the investment that's required and the risk in the project. So in addition to the complexity and scale of that particular project. So one final note on profit. Whilst we have mostly referred to profit on GDV, there are other useful measures which include profit on cost, internal rate of return, and return on capital employed. You'll see that most appraisal software will automatically calculate these measures along with profit on GDV, so there's an easy comparison there. Next slide, please. Okay. So on to our final appraisal component, which is residual land value. This is a key component of the development appraisal, and it's most often the key outcome derived by the appraisal rather than being a fixed input. So only where the GDV exceeds the total development costs and profit, including profit, can a land value be generated. So whilst a land value may be generated in an appraisal, this doesn't always mean that the land value will meet the expectations of the landowner, which can result in the land not being released for development. And so on this basis, it's common in viability to establish a benchmark land value, such as existing use value, or EUV, as you may hear it referred to, plus a premium as stated in PPG guidance. So this benchmark land value could also be based on alternative use value, but in this case, no premium should be applied. And the alternative use value should also be capable of being implemented. Okay, so that brings us to the end of the components and to the end of part one of the session. And so I'm going to hand you over to my colleague Dale, who will be exploring in a bit more detail development appraisal through his interactive session. Thank you.
Hi, thanks, Rachel. Yeah, so the purpose of this part of the session is to make it a bit more interactive, a bit more hopefully interesting, and you can see how some of the assumptions that Rachel has talked through, how they impact on a high level viability appraisal. So it's a basic residual I'm going to talk you through. I appreciate some on the call may be more familiar with detailed cash flows. For the purpose of this session, it is a basic residual. I was hoping to run it through our Argus appraisal software, but unfortunately it's multi-layered, which means it's very awkward and difficult as an online demonstration because it doesn't allow that instant, doesn't allow me to present what the impact is on a sort of simple straightaway screen. I have to go in and run various reports, etc., before we can understand the answer. So I'm basing it on a static Excel, and what that means is there's no cash flow, so that has implications in terms of how we calculate finance. But we would always recommend when undertaking appraisal that you do have a cash flow, because that's a key part of the overall viability argument, and that's what drives the finance costs. And the purpose, as I alluded to briefly earlier, is to help put into context what both Andrew and Rachel have talked about, and just explain what are the key influences in terms of changes to the appraisal output. So in terms of the case study, I want to focus on a greenfield site, 3.9 hectares, about 10 acres, adopting a density of 25 dwellings per hectare, policy requirements 20% affordable housing, and that's split between 70 to 30% social rent. And when we get into the interactive session, we can experiment with changes to both the level of affordable and tenure split, because I appreciate many attendees from different local authorities will have different requirements in terms of affordable housing. So the resultant dwelling mix is 98 dwellings, 78 market dwellings and 20 affordable. We've got Section 106 financial obligations. Typically, we've got allowances for education, sport, highway, and biodiversity, totaling around £850,000. Appreciate there may be others obligations in other local authority areas. We've got an average sale value of £215 per square foot. In terms of the affordable, we're valuing this at 60% of market value. For the social housing and intermediate dwellings at 80%. I'm aware that some local authorities here in Leeds, for example, they set out the transfer values for affordable housing in a supplementary SPD. So if that's the case, you would need to obviously reflect that in the appraisals. We've got build costs of £90 per square foot. Typically external works at around 15% of build costs. We included abnormals at about £1 million. Got contingencies at 3%, project fees at 6%. And we've got some allowances for sale agents and marketing costs. And finance costs we've included at 6%, but because we haven't got a cash flow, we've applied this to half of the build costs over a total development period of 45 months, which is 3.75 years. We've applied a blended return of 20%. You heard Rachel explain earlier about PPG range for profit. Also, the suggestion that affordable housing can be at a lower profit. And again, we'll look at some of those issues when we get into the interactive session. Benchmark land value, I've got £867,000 benchmark land value. I did notice there was some comments coming on the chat actually around how benchmark land value is calculated. So how I've approached this in terms of this example, because it's a greenfield site, typically agricultural land can range from between £8,000 to £11,000 per acre. I adopted a midpoint of 9. There isn't any guidance to what the premium should be. What I have tended to refer to, and a lot of my fellow practitioners have referred to, was a historic, and it's now a withdrawn document that was issued by Homes England, previously trading as Homes and Community Agency many years ago. And that did advocate a range of between 10 times and 20 times EUV for greenfield sites. So the example I'm sharing today is based on 10 times EUV, so that's based on £90,000 an acre. But it's much more complicated when you have a brownfield site, for example. Recently dealt with a scheme in Stockport. It was a previous food store, Sainsbury's. It became vacant, Sainsbury's had moved out. So in terms of looking at what the existing use value for that, there was no continued use as a food store. All the main food store operators, including discount operators, were present within the town. So we accepted as a use for a food store wasn't a viable proposition. But actually, the site in question was very near a large edge centre, large format comparison retail park. So we put forward an argument that actually the building could be refurbished and put to use as large comparison format retail. And we adopted rents and comparable evidence on yields to get a capital value. But then we also made a large assumption in terms of refurbishment fit out costs to put the existing building into a format which was suitable to encourage the change of use. So yeah, it can be very difficult for brownfield sites. It's easier to get a benchmark land value for greenfield sites. So at this point, I need to stop sharing the presentation. I'm going to bring up the Excel spreadsheet. In doing that, I'm going to turn off my camera because I had a dry run earlier, and I do need to look around the screen, and it does result in me pulling some rather peculiar faces. So I'm going to turn off my camera. So just let me do that for 1 second. So Rachel, Andrew, can you just confirm you can see the appraisal for me? Is that all right? Okay, cool. So just referring back to the slide earlier in terms of the case study, this is the case study presented. So you can see, just working down from the top, we've got the site area, 3.9 hectares, density 25. You can see the split in terms of housing, 20% affordable, and then the split of the affordable, 70-30. You can see what that means in terms of private dwellings, 78. In terms of the values, you can see we've got the base value at £250 a square foot and build costs at £90 per square foot. Working down the appraisal, tried to replicate this following the example of a pro-dev appraisal. So we have split out the revenue from the private sales in a bit more detail in terms of the housing typologies, ranging from 2-bed terraces, 3-bed terraces, and semi-detached down to 4-bed. You can see the affordable housing typologies in blue. So we've got predominantly social rented 2-bed terrace and 3-bed terrace at intermediate. I appreciate, in the real world, with many variations of the mix. Going through to the development costs, again, just replicated from above the housing split. We've then got external works, 15% of the build costs, which is the 9.831. See the abnormal costs we've got in there at £1 million. Got contingency at 3%. And that's 3% of the build costs, the external works, and the abnormal costs. On the contingency, just need to be careful. Sometimes when you get cost reports from consultants setting out abnormal costs, there is already an element of contingency included within the abnormal costs. So you just need to be mindful of that in the real world to make sure you're not double counting a contingency on abnormals. And we have section 106 costs. So you can see the split between the education, sports, highway, and biodiversity gain. Again, there may be others in the real world. Project fees of 6%. Then got the disposal fees, sale agents, marketing, and legal fees. And that results in total costs, excluding finance, at about 14.8 million. Looking at the finance, we based that on half of the 14.8 million over the 45 months construction period, and that derives an interest cost of 1.8 million. When you're looking at this running through a cash flow, this figure will be vastly different because you do need to run, you'll have your 6 months leading into the construction. Most developers then operate a build to sales because essentially they'll want to ensure that whatever house they're building, they've got the end purchase already lined up to avoid a situation where they build a number of dwellings and then can't sell them. It's all about mitigating cash flow risk. In the real world as well, particularly large PLC developers, they may have a corporate facility where it's covering several sites, and there may be situations where they move money around sites. So if they've got one site which is generating a lot of sales and it's cash positive, they will use that cash surplus for one of another site which may be only starting out on the development and have quite a lot of negative cash flow issues. So again, it will vary in the real world, and whether it's a big corporate PLC or a smaller SME. So we get total development costs 21 million, and what we effectively take those costs from the GDV earlier, which is the 22.3 million. Scrolling back down. Simple deduction in this scenario shows a land value of 1.2 million. We then need to obviously take off stamp duty and purchasers costs, and that results in a net residual of about 1.1 million. And we had a benchmark of 867. So you can see in this scenario, we've exceeded the benchmark by around £270,000. So in this case, the landowner's happy and the developer's happy, and the local authority are delighted because they're getting their affordable housing under the Section 106 matters. So what I want to do now, having explained that the base case, is just understand some of the assumptions and how they may change what that resultant outcome is. So the first thing I want to look at is density. I'm sure many of you on the call will think a density of 25 dwellings per hectare is quite low. And it is, and I deliberately set it low, so we can understand what impact changes to density will have. So if we look at maybe increasing that to around 35 densities per hectare, keeping the same affordable housing mix, what you can see there is the total number of dwellings increases from 98 to 137. That's an increase of 39 dwellings. Affordable homes have increased from 20 to 28, so there's 8 more affordable homes in this scenario. And the private homes have increased from 78 to 109, so that's an additional 31 private dwellings. But interestingly, as you can see, we've got more housing, so naturally we've got more GDV. We've got around 9 million additional GDV, which is great. Equally, more dwellings, so the more costs, so the construction costs have gone up by nearly 4 million, as you would expect. The related costs of external works, they've gone up by nearly 600,000. Abnormal costs have stayed the same because the site area and the issues around the site haven't changed, just the density. 3% contingency, so there's additional contingency on those additional costs of around 135,000. The Section 106 costs, they stay the same, they don't change. Project fees, again, because it's linked to costs, we've got another £270,000 of fees in relation to the additional build costs, external works. And finance costs, again, clearly more cash putting through the scheme, the higher the finance. We've got, and because we've generated more revenue, the 9 million touched on previously, because profits based on revenue GDV, we're driving additional profit for the developer of about 1.8 million. So in all, the total development costs are now at about 28.6 million. So that's an increase roughly of 7.5 million. But if we refer that back to the GDV increase of 9, so the changes have resulted in more GDV than costs. So net impact of changing the density to 35 dwellings per hectare is now a land value of 2.4 million there or thereabouts, and that's an increase on our base case scenario of about 1.2 million. So again, that's over the benchmark by about 1.5 million. So you can see density does have an impact on viability, and I have dealt with some projects in the past where a lot of the viability challenges were associated with very low densities, and some of the issues we had to grapple with was that the developer wasn't effectively making efficient use of land, and we had to go back, or the local authority had to go back and have discussions around how the scheme could be changed and how a more economic advantageous density could be applied. So I've just put that back to 25 to reset the base case. The next section, the next input we can look at is sales revenue. And what I want to look at is, well, what impact does that have? So if we assume in the first instance that sales values go up by 5%, so rather than being £215 a square foot, the sales value increases to 226. So it won't surprise you, obviously, that the GDV increases to around 23.4 million. That's an increase of just over £1 million. So 5% increase on sales values generates just over £1 million. Obviously, there's no impact on the costs in terms of build cost, external works, abnormals, contingency, Section 106, or project fees. But there is a small increase in costs on disposal fees because they are linked to the amount of GDV being generated, but it's only small amounts. And there's a small increase in finance costs, again, linked to the small increase in disposal fees. The profit obviously increases because it's linked to the GDV. So in this scenario, there's another £250,000 additional profit. But naturally, there's more increase in value than there is in the overall cost. So again, in this scenario, the net land value has increased over the base case by around 800,000. It's currently at 1.9 million. And again, that's in excess of the benchmark land value. So we can, as you can expect, if we were to look at a 15% increase in sales values, that would increase to £247 a square foot. I'll quickly go through this because it's the same principles. You know, there's additional revenue, in this instance, 3.3 million. So in principle, the majority of the costs don't alter. There's increases in the disposal fees, but you can see here that the main difference is obviously all dropping through to that increase in net residual land value, 3.5 million in this instance, which is 2.4 million higher than we had in the base case. So we've looked at increases in sales value. We obviously need to look at a decrease. So we look at a 5% decrease, that would bring the sales value down to £205 per square foot. And you can see straight away there's a reduction shown by the red figures of about £1 million through a drop in sales. And same issues as before, there isn't really any impact on the majority of the costs. There's a small saving on the disposal fees. Finance costs, again, small reduction down. When the GDV drops, and if your developer's taking profit on GDV, clearly their profit will drop, £250,000 in this instance. So as we can see here, with a 5% drop in sales values, the net land value is now £325,000 or thereabouts. That's an £800,000 reduction on the base case. So in this case, we've dropped below the benchmark. We're considerably below the benchmark, around £540,000. So in this scenario, it's unlikely the landowner would release the land for development, and there may be concessions on a Section 106 obligations, or actually, the developer may need to go back and do some cost engineering on some of the abnormal works or the build costs, etc. And if we just ran another one, which looked at 85%, so that's a 15% drop in build costs. Again, I'll quickly scroll down to the bottom because we're familiar with where the main impacts are now. You can see here that in this instance, the scheme becomes unviable. There's a negative land value being generated. So in essence, it's costing more to build this project than the value you're generating. So it's just an unviable project, and this wouldn't happen in the real world because there's no money to be made. Let's go back to the top. So we've now put that back to 100% to reset the base appraisal. Excuse me. So if we now look at construction costs, so let's look at 5% increase in construction costs. So again, we've gone from £90 a square foot to £95 a square foot. Won't surprise you, there's no impact on the value. You can see that the costs have gone up by about £500,000. Naturally, the external works go up because they're linked to build costs. No change on the abnormals. Contingencies increase because they are linked to build and external works. Section 106 remains the same. Small increase in project fees because the costs are linked. Disposal fees, no change because they are linked to GDV. Naturally, there's some increase in finance costs. Profit stays the same because profit's based on the GDV. So in this instance, the land value has dropped to £490,000. Again, that is below the benchmark land value. So in order to make this appraisal work, and I can come on to this later, is concessions on either affordable housing or the Section 106, or again, cost engineering solutions would be needed. Again, we'll just look at 115 just to show the impact of a much larger increase on build costs. And why I want to show this is reflecting where we are in the market. At the moment, there's a lot of volatility in the market, and we are seeing that costs are increasing quickly and substantially month on month. So 15% increase over the past year isn't, it's actually that's reasonable. That actually has transpired in the market, and you can see here the same principles in terms of the costs which are impacted. But again, that level of cost increase on this appraisal makes the scheme unviable, generating a negative land value. Let's just look at decrease in build costs, 5%. Again, I'll quickly scroll down because the principles are the same, but build costs reduce around £500,000, and there's reductions in external works, contingency, all the related costs, project fees, finance as well. So in this scenario, if there was a 5% reduction in build costs, the net land value increases to about 1.8 million. And that's about £640,000 increase on the base case, and it's beyond the benchmark as well. And again, just to show you a 15% reduction, which is unlikely in the current market, but I'm sure you'll appreciate that the impact is substantial. So the net land value being just over 3 million, which is nearly 2 million higher than our original base case and well beyond the benchmark. So if I just go back to the top, reset that back to 100% to recalibrate the base case. So let's look at a scenario in which both sales values and costs increase. So let's assume they both increase by 5%. So sales values are at 226 and the build costs have gone up by 95. So we've been through this previously, but you can see we're now looking at changes to build costs and abnormal costs. So the difference will be manifest throughout the appraisal. So the revenues increased by 1.1 million. The build costs have gone up by about £500,000. External works have gone up by around £75,000. Small increase of contingency. Section 106 haven't changed. Project fees increased slightly. Slight increase in disposal fees. Finance costs increase ever so slightly. So the total costs have increased by around 720,000, all because of that small increase in build costs. So that £500,000 in build costs also drives an additional £200,000 there or thereabouts increase in other ancillary expenditure. Profit has gone up because that's linked to GDV, which we've increased by 5%. So in this instance, the land value has increased. So a 5% increase in sales revenue and build costs still results in an increase in the net land value of about 1.3 million. But let's look at a scenario whereby we've maybe the build costs exceed the increase in sales values. So in this instance, we've kept the sales increase of 5%, but the build costs have gone up 10. So the increase in revenue is still at 1.1. But now the increase in build cost is nearly £1 million. We've got an additional £150,000 thereabouts of external works costs. Contingencies increase, ancillary fees have increased. So overall, including finance costs, there's around another 1.5 million of development costs, in addition to extra profit driven by the 5% increase in sales values. So in this scenario, actually the net land value has now fallen. It's 653,000, and that's around £480,000 less than in our base case. And it also has fallen below the benchmark land value. We've looked at the impact of costs and the values. So look now at profit. So just scroll down to the profit line, which is here. So this appraisal is built assuming a blended GDV of 20%. Now we heard earlier on PPG saying 15 to 20%, and also suggesting it could be lower for affordable housing where there is a known end purchaser at known values. So in the first instance, let's just look at, well, let's assume a 15% blended GDV, which is much at the lower end of the range from PPG. So you can see here that would result in a saving of a profit of 1.1 million. If we scroll back up, changing the profit doesn't really impact any of the other assumptions. It literally is just changing the level of return the developer's taken from the scheme. So all that flows through into the net land value, of it, which is now about 2.1 million. There's additional fees in terms of stamp duty and purchases costs, because obviously the gross residual land value is higher. But also overall, we're about just over £1 million higher than our base case. So that's significantly higher than the benchmark. So profit, is a big driver of viability and can influence whether a scheme does exceed or otherwise in terms of the benchmark. So let's just we put that back to 20%, but in terms of affordable housing, let's just assume it is at 6%. So as you can see, there's a small reduction on the affordable profit by around 320. And again, that just drops through into the net land value, which over our base case has increased the net land value by about £300,000. Not quite the saving on the affordable, again, because there's additional stamp duty and purchases costs to pay. So the other area to look at is abnormal costs. We just assumed just a flat rate of £1 million for abnormals, and the abnormal costs can vary considerably site by site. There was some conversation in the chat earlier around what constitutes an abnormal cost. Most developers have a standard house type product or products. Very flippantly say they have off the shelf products, which they costed down to the nearest pound and pence. So anything which deviates from their standard house types, then the industry will classify as an abnormal. And developers do classify different things as abnormal. So there's no uniform definition of abnormal. My interpretation of abnormal is things which are particularly abnormal to a particular site, and particularly in the ground. So you might have a situation where actually you've got very poor ground conditions, and it means all houses have to have pile foundations rather than the typical strip foundation. So in this instance, let's assume that all the houses need to have pile foundations, and that increases the abnormal costs to £2 million. You can see we've got the additional million, but there's the additional contingency on the abnormals. Again, project fees, additional design work on the pile foundations. The costs have gone up by just over £1 million, but there'll be finance costs on those additional costs. So as you can see here, that additional abnormal cost of £1 million has made the scheme unviable. The land value is essentially about minus £17,000. So just look at £500,000 increase. Again, the same principles apply. So in this instance, so this is a situation where the abnormals have reduced, so they've come down £500,000. Again, that just flows through into the land value. So we are considerably higher than the benchmark here. If we had 1.5 million, £500,000 increase, ancillary costs on top of that. So we're still viable, but the net land value is below the benchmark land value. And then there is, let me just put that back to £1 million. There's some other small changes we can make to the appraisal just to test the impact, but the main sensitivity assumptions are around building sales. So we could look at external works. I mean, typically they range between 10 and 20%. 10% more typically associated with apartments because there isn't much in the way of landscaping, etc. But we've got a large housing scheme which may have significant areas of landscaping be higher. So let's just look at what 10% does to the costs. So that would save you around £500,000, nearly £600,000 once you'd factored in the related costs and finance. If you're going the other way, looking at 20%, that's adding on 600,000, and that would bring your land value below the benchmark. I'll show you what the changes to contingent. I mean, it's such a small amount, so it doesn't really change. Brownfield site, you might typically be looking at 5%. So you can see in this instance, 5% adds back 250 grand onto the costs, plus additional finance costs. So, you know, it's not inconsequential. A small increase of 2% contingency can, you know, add up and start to add up. And if you add on other changes to variables, you can quite quickly see how all these changes can layer up and have a significant impact overall. Project fees, let's just assume that that's 10%. So again, that will be an additional around £500,000, which obviously feeds through into the bottom line and brings the net land value below our benchmark of 876. Back to. So what I want to do finally is look at a scenario where we have a situation where the benchmark isn't exceeded. So I need to put the sales value at £205 square foot for that. So this just shows you what impact that has on the revenue. But let's just assume this is now our base case. You can see here that we've got a scheme which is positive. You know, it's generating a net land value, nearly £400,000, but that's considerably below our benchmark. So if this was a planning and viability argument, assuming people were accepting the 20% blended return, there would be a need for some concessions. And let's just assume there is no scope to value engineer the scheme in terms of any cost savings. I think, and this is the real reality in the real world, is that most developers will, you know, first port of attack is affordable housing. So they'll come straight to the level of affordable housing and see what they can negotiate away. So in this instance, we take out 12 2-bed social rent dwellings. That means we've got 8 affordable dwellings. So in this scenario where we've got to, you can see how I've created this previously because we're almost get to where we need to be. So the net land value is at 874,000. So in this scenario, by removing those 12 affordable dwellings, we get to a benchmark land value, which is slightly higher. Sorry, we get to a net land value, which is slightly higher than the benchmark. So in this scenario, that's what the developer would be arguing. They'd be arguing for those 12 affordable dwellings to be removed. But the reality is, rather than coming straight and for the level of affordable housing and challenging and attacking that, there may be scope to say, well, actually, have the build costs been interrogated robustly? Because it might well be that actually, a small decrease in build costs, let's say 2%, doesn't quite get there. We're not quite at the benchmark, but that might just mean we just need to take out fewer affordable. So in this scenario, we see a 2% drop in build costs and we're taking out 4 affordable. Again, not quite there, because we're at £740,000 net land value, so not quite at the benchmark. So we might need to take out another affordable. Scroll to the bottom. So we're nearly there here. I'm not going to continually do some changes. So in this scenario, we could probably get away with some small reduction in the build costs, plus some reduction in the affordable housing. But rather than previously having 8, in this scenario we've got 14. So this is just demonstrating the merits of actually challenging all of the assumptions, particularly build costs. Anyone referencing BCIS, we'd certainly recommend you challenge that, because there's a BCIS data is known to be unreliable, particularly for large schemes which have been brought forward by PLC developers. PLC developers don't input into the BCS sample data, but it's tricky because it's their little black box, and no one really knows what costs they incur to build their units. Anecdotally, I've heard some really low figures ranging from £50 per square foot from their basic standard house type, but again, that comes back to truly understanding what they mean by their basic standard house type and what additional costs they layer on top for abnormals. The other situation we can look at here is actually the extent of the abnormal costs, because any saving in abnormal costs in this scenario, we've saved £500,000 in abnormal costs, and straight away you can see that even with the reduction in the sales value, any saving in abnormals feeds through into the bottom line. And I think that probably takes me to the end of my session, because I'm conscious of time, and I'm conscious I've probably flitted around the screen quite a lot. Hopefully you've managed to follow me and keep track, but I'm happy to take questions. I'll stop sharing now.
Thank you. Thank you, Dale. We had hoped there'd be a bit more time left over for questions after this session, but as is the way with these things, I think we've run on a bit longer than we anticipated, and I know that James has got to do a wrap up. We tried to answer questions as we've gone through the session. I am going to raise one actually, which has been flagged to me by a number of people, and it's just a question in relation to what account you would take now on additional build costs related to Part L, etc., and would they be treated as abnormal costs or not? I think the answer to that one really is it depends on how long the scheme is going to span over, and whether those costs are actually going to bite or not. So clearly, the closer you get to those costs coming into force, the more likely they are to be reflected in an appraisal. To give you an example, we had a tender the midpoint last year where we asked parties to identify potential abnormal costs, and at that point most of them were highlighting increases in build costs because of Part L as an abnormal, whereas a similar exercise just before Christmas, the developers weren't identifying them as abnormals, and were therefore pretty much reflected as part of the development cost, because by the time they get reserve matters, if they're buying on an outline and start constructing the units, those costs will come into play and will be taken into account anyway. So, effectively, whether they're abnormals or not, they're in the appraisal anyway. But generally, I'd not regard those as being abnormals anymore. So James, I think I need to hand over to you. Apologies, we've run out of time on the questions. So I will do that. Thank you, James.
So thanks to our speakers, Andrew Moss, Rachel Hill and Dale Robinson, and to everyone for attending. Thanks to the support team in the background. And we hope to see some of you at the sessions in the coming days. Thanks very much, everyone.